Well, another story that we're tracking, a sense of stability, trying to return to markets here. Banking fears taking a backseat, at least for right now. Focus shifting to the path of monetary policy ahead of the Fed's rate decision in May. Joining us now, we've got Anastasia Amoroso, who is the iCapital Chief Investment Strategist. Anastasia, great to speak with you as always. I don't believe we've been able to get your broader perspective on what's played out and if we really are out of the woods yet, or at least if the market is signaling that we're kind of out of the woods, or just waiting for another shoe to drop on the other side.
Well, good to see you, Brad. And I do think that this sense of stability is actually justified, at least for the time being. I mean, we had three, I would call them pretty critical developments in the last several weeks. First of all, the reason why we've seen, this flight of deposits, one of the reasons is because people were shopping for better options where they can park their cash. And if you look at sort of what happened after the Fed meeting last week, I call it a de facto pause because they told us with a summary of economic projections that they may actually pause around 5.1% this year. And as a result of that, you've got the 2-year Treasury that moved down a lot from at some point it was 5%, now it's just a little bit shy of 4%. So as a result, I think it sort of slows down this shopping for yield, appetite that we've had before. So that's one thing. The second thing is, we still don't have an explicit guarantee, but I think on deposits, on uninsured deposits, but I think we've heard more and more sort of a consensus emerge from policymakers that if warranted, there would be such a guarantee. And then the last thing, Brad, I think just the fact that we've had some positive resolution to, several bank wind downs, that also contributed to the positive sentiment there as well. So, you put that together, and I do think the sense of stability for now is justified. If you ask me, are the banks completely out of the woods? I would say no. There's commercial real estate issues. There's just the lower net interest margin issues, but that doesn't necessarily need to spell a broad crisis.
So, Anastasia, given all of that has brought stability to the markets, now what, right? Now where are you turning your attention for a potential next catalyst that is either going to unlock some gains here or send us back lower?
Yeah, I actually do think, Julie, that we are poised to hopefully unlock some gains in April. So I'm looking forward to that as a potential positive month. First of all, you've got seasonality on your side in April. Stocks tend to be up 76% of the time, using kind of a long history of data. And on average, they deliver more than 1% for the month of April. But, that stat aside, you can't just rely on that, of course. What I'm encouraged by is that we have significantly reset lower the positions across the board. You've got hedge funds that have reduced their exposure to equities. You've got mutual funds that did the same thing. And then you've got some of the systematic trading advisors also reduce their net equity positions to really the lowest level since 2020. So you take that and you say, well, we're right at this near-term technical level of 4,000. So if we just manage to have a little bit of positivity, a little bit of stability in the market, then we're going to be above that 4,000 level. And that is likely to cause some of these systematic investors to get back into the market. But because they're getting back from such a low positioning standpoint, their appetite to buy can actually be pretty significant. So I like that technical force that can, play to our advantage in April. And then, technicals do not work without the fundamentals. So on the fundamental side, maybe you have the Fed pause, maybe you have bank stability. But I actually also think the earnings season may be better than people expect. Because once again, the bar for this earnings season has been reset a lot lower, Julie. And then you look at the economy, and it is not done nearly as poorly as people feared. In fact, we're tracking 3% GDP growth for the first quarter. So I actually think that companies may benefit from this stronger than expected environment and deliver better earnings. So that could be your fundamental catalyst.
So are valuations then, are they acceptable? Are they attractive at this level? And especially in a sector like tech, where we've seen a massive pickup in recent weeks.
Yeah, I don't think valuations are extremely attractive, Brad, but I also don't think they're extremely stretched either and overvalued because, some people might argue, well, 16, 17 times, that's expensive when you think about the Fed, when you think about the economy slowing down. But if this economy for now managed to hang out around these levels, if we're not going to have an imminent recession, then we don't have to have a recessionary multiple of 13, 14 times. So to me, where we're trading today, whether it's on the S&P or the tech sector, is actually fair. And then technology itself, if you look at the NASDAQ, for example, the multiple was 35 times forward earnings about this time last year, and is now reset lower to 22, 23 times. So that's a massive reset. You've got semiconductors that have traded cheaper, and then you've got a huge multiple reset in software as well, from something like 20 times EV to next 12 months earnings to about 5.5. So that's pretty a significant reset. And again, to your point about technology, in a sector that may actually be sort of defensive from the earnings perspective. It's not a cyclical sector, it's not energy, it's not financials, but it also is something that has the secular tailwinds as well. So I think you put all that together and you don't get the excessively attractive multiples, but I don't think they're stretched either.
Yeah, maybe you get some opportunities at the very least. Anastasia, great to catch up with you as always. Anastasia Amoroso, iCapital Chief Investment Strategist. Appreciate it.